Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we are following in the BNN Bloomberg newsroom. The Bank of Canada held the interest rate steady at 2.25%. The bank offered new forecasts in its monetary policy report and sees Canada's economy growing 1.1% this year. Policymakers are citing heightened uncertainty that remains an overhang for the rate path.
Uncertainty around our forecast is heightened. The range of possible outcomes is wider than usual. U.S. trade policy remains unpredictable, and geopolitical risks are elevated. With heightened uncertainty, we are monitoring risks closely. If the outlook changes, we are prepared to respond. Monetary policy cannot compensate for the structural damage caused by tariffs, and it can't target hard-hit sectors of the economy.
The U.S. Federal Reserve officials left interest rates unchanged and signaled a more cautious approach to potential future adjustments. The benchmark federal funds rate was held in a range of 3.5 and 3.75%. In a meeting statement, policymakers said job gains have remained low and described the pace of growth for the economy as solid.
This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis.
Shares of Starbucks are climbing today. The coffee chain topped expectations for global sales, which rose 4% at established locations. The American company also issued its first full-year outlook, with sales forecasted to grow at least 3% in 2026. As part of CEO Brian Niccol's turnaround efforts, Starbucks has focused on improving service and offering a simpler menu. Here is where we stand on the market today. The TSX up 64 points to 33,161. We'll check if that's a record in a moment. Let's go south of the border. And not a lot of movement on the S&P. It's down 1 point. The Dow Jones, a drop of 39 points. So again, not a lot of movement there. And the Nasdaq up almost 50 points today, 0.2%. As you heard, the bank has held the key interest rate today. That was widely expected. But let's take in a panel of guests here to talk about this. We have Ed Devlin, founder of Devlin Capital, and then Paul Beaudry, senior economic advisor at Bennett Jones, former deputy governor of the Bank of Canada. Welcome to you both, and thanks for joining us today. Paul, I'm going to start with you. How difficult is it to plan or even project, given the U.S. administration's constant threats of tariffs and shifting policy?
Well, it's certainly very difficult. They kind of looking forward, trying to decide what kind of tariffs we might have going a year from now, especially as we're kind of going to renegotiate this CUSMA. It's very hard to predict how the Trump administration will approach that. Right now, we can take a certain view and hope that we can kind of get a reasonable deal, but it's very much hard to predict.
Okay. Ed, you manage money in a situation that has been pretty volatile for the last year. So what has it been like for you?
Well, actually, it's been quite positive for us because, the Bank of Canada has been cutting rates, which, has helped the performance of bond funds.
Okay. Paul, let me go back to you. Do you feel the rate is where it needs to be right now? And if so, why?
Well, it's, if we look at the kind of measures that we have here, first of all, one of the things that really came out from the monetary policy report that the Bank of Canada put out today, if you look at the inflation part, inflation is really under control in Canada. So that's really a good news after that high period of inflation we had going, 22, 23 through that period. Really, inflation seems to be under control. So now it's really kind of thinking, is the economy needing more help or not from the Bank of Canada. And I think with the rates at this level right now, the Bank of Canada thinks it's giving the right support. It's giving room to kind of think if it's not giving it, it can move on the other side. I do think at, unemployment still at 6.8%. And kind of growth only at 1%, 1.1% for next year. It seems like the economy needs an extra push, but a lot of that is due to structural factors. But again, I would see that the idea that this isn't bad, but if anything, maybe rates might towards the end of the year decrease a bit.
Okay, so let me turn that back to Ed. Ed, do you think the economy still needs help, given some of the factors that we heard from Paul? We have the unemployment rate higher, and the growth is kind of for this year.
Yeah, no, I would agree with Paul. I think that the bank's overall assessment, it's very hard because of the uncertainties, but overall I thought we were slightly optimistic. They'd upgraded global growth by 0.3 and U.S. growth by 0.4%. And so I would be in the camp that the risks are for a couple of rate cuts, especially since they don't have a lot of room to move with growth, as Paul said, around 1%. The thing that would be, I think, that's going well for them is, having Mark Carney as now the head of the fiscal agent as opposed to the central bank. I think what we saw with the announcements recently with rebates to the GST for relatively poor people, that's a very and front-loaded, very effective fiscal stimulus. So I think the bank is going to have a good partner with the government. If we do have weakness, using fiscal tools as well as monetary tools.
Paul, did you think that the GST credit, which will be upped, was needed? You said inflation is relatively under control.
Yeah, well, it's certainly helping. And so we really know there's some people that are really struggling with, high prices, especially of food and different aspects. And so the GST. What we do have to have an eye on is still the deficit in the case of Canada. There was really a kind of discussion in the last budget of saying, okay, we might make deficits for investment reasons, but when we cut the GST like that, that's not investment. That's really a spending. So there is aspects of trying to figure out, okay, what kind of package this government will want to kind of figure out in the long run to pay for some of these helps. This is a temporary kind of change in the GST, but once you put it in, it tends to stay there. So we have to figure out how we're going to pay for things like that.
Okay, I do want to pivot to the CUSMA renegotiation, which is supposed to happen this year. That's a big overhang. It's part of the uncertainty that we've all referred to. Ed, with that overhang, do you feel like you have to be ready to pivot if and when perhaps that doesn't happen?
It's going to be very tricky for not only market participants but policymakers and negotiators, because it's hard to see a Trump administration or Donald Trump's tariffs seem to be his favorite word and his favorite tool. So I can't see how he just gives it up. We renegotiate CUSMA and we never hear from him again. He seems to be in the news cycle a lot. So I think we're probably in for a prolonged period of volatility on that trade front, and it's very unclear to me how it gets resolved. And our base case would be it really probably doesn't through his term, in which case I think there's probably more risk of rate cuts, and it's probably good to be overweight bonds.
Okay, Paul, let me turn it back to you. Do you think that there will be a renegotiation? Does it even matter if there is? Because picking up on what Ed had to say, whatever happens, on one day with Donald Trump isn't necessarily what he's going to follow through on the next day.
Yeah, but still a renegotiation would really help. Like if we look at what happened in these kind of more recent times, it still is that for a lot of the goods that are CUSMA compliant, we do not have tariffs on them. And so there's still been not a full respect of the agreement we had, but quite a bit of respect for it. And I think the same thing going forward. It's not the same kind of done deal, even if we get something, but I think getting something would be better than not, and especially if we can get this agreement to cover at least all the goods that kind of right now are not over-tariffed to continue, that would be really helpful. And that's under the Bank of Canada's forecast for growth, kind of assume that as kind of its baseline. So everything else is kind of a loss.
Okay, but what happens if we get tariffs, even if they're sector-specific, even if they're higher on the sectors that are already being tariffed right now? Ed, I'll start with you on that.
Well, I mean, I think it's just going to increase uncertainty. It's going to dampen consumer and business investment, and it's going to be a significant headwind to the economy. So I think it's just that simple. It's just not very positive.
Paul, what about you? If we get tariffs, even if they're limited in nature, how much damage could they do?
Well, I think you really have to figure out what we mean by limited in nature. I mean, getting that quantitative aspect is really important, figuring out like how big are the sectors being affected, how are they affecting, how their general view of the uncertainty associated with that. So yes, there might be some small sectors that are kind of affected. That's really difficult for those sectors, but might not matter for the overall economy. So I don't think it's a black and white type of thing. You really have to get into the details and see what's going to be affected and where and how much it affects really the consumer confidence, which is really the thing that's been holding up the economy right now.
I do want to ask quickly what you think as a catalyst for a better year this year, because we don't know what is to come from Washington. What could act as a catalyst this year for the Canadian economy? Paul, I'll start with you on that one.
Well, a big part is exactly, we've already discussed it. So the CUSMA kind of having some certainty in there would be really the great aspect there. It would make a big difference. But other things, as we'd see, there's a kind of theme that's been in the background with the Carney government of saying, big projects are going to go in faster. There could be that change in atmosphere of really getting in some of those investments, putting them in and getting things through. And that could really help as we're trying to have trade kind of expand for other countries through this year.
All right. Ed, anything you could see as an outside catalyst that could help the Canadian economy this year?
Yeah, I mean, I think good fiscal policy. Personally, I think these investments in infrastructure probably aren't really going to hit the tape this year. They're kind of longer term in nature. And I'd hope that the government, promotes more, kind of tax reform that's focused on capital formation and business formation to really kind of unlock, the domestic Canadian economy. If we saw anything moving in that direction, I think that could be a real catalyst.
Got it. Ed Devlin is the founder of Devlin Capital. Paul Beaudry, senior economic advisor. Bennett Jones, former deputy governor for the Bank of Canada. Gentlemen, thank you both. Appreciate it.
Thank you.
Coming up,
Thank you.
The U.S. Fed held the interest rate steady south of the border, so we'll talk about the details there in a moment. The U.S. Fed decided to hold the interest rate steady for the first time since July. Let's go to Danielle DiMartino-Booth on this, CEO, Chief Strategist at QI Research. Thanks for your time.
And thank you for having me this afternoon.
So the Fed has its eye and has had its eye on employment in the U.S. They see it as steadying now. What's your current outlook for the labor market?
Well, I thought it was an interesting characterization. I was happy that Chair Powell at least spoke to the underemployment rate. We have quite a few white-collar job losses going on just here in the last week or so. About 50,000 have been announced by some fairly large corporations, and we really haven't gotten into the thick of earnings season when some of the weaker players like retailers start to announce their earnings and layoffs along with them. So it was a bit disappointing that they shifted their focus so far away from the labor market when the survey data is unequivocally telling us that we are where we've been in past recessions when it comes to how U.S. households perceive the job market.
Yeah, definitely consumer sentiment has also been very down in the U.S., but that discord between sentiment and actual spending has been going on for the past year.
It certainly has. But I think, as we know, for example, the top 10% account for nearly a third of all hotel spending. There's a very disproportionate imbalance in the U.S. economy between those who are in kind of this top 10% and account for nearly 50% of spending, and the other 90% who are suffering wage disinflation and really struggling with the cost of essentials, such that, as Chair Powell pointed out, we are seeing disinflation in services spending can continue, and that he expects to see disinflation set in on the good side of the economy once the final effects of the tariffs have been wrung through the system.
Yeah, the Fed says the outlook for the economy has improved, and I'm wondering if you think that is because tariffs have worked through, or what else has been holding up the economy in the U.S.?
Well, I think what Powell was speaking to in many ways today was the hard official GDP data, and the GDP data kind of runs in the face of private sector job losses, especially when you net out what we call the recession-proof industries of healthcare and education. The fact that we've actually been seeing job losses in that arena since April of last year. So it was again. I think what he's referencing are things like, in isolation, the unemployment rate falling to 4.4%, even though underemployment remains very high, as well as headline GDP figures, which, of course, we know will be subject to revision. But that's several quarters, if not years away, given the disruption caused by the government shutdown with our statistical agencies.
As you know, Jerome Powell was asked questions about the legal case that is moving forward against him from the Department of Justice. Are you surprised, or are you not surprised that he didn't really answer those questions, kind of left them alone?
Well, we have to remember that Jerome Hayden Powell is Jerome Hayden Powell, Esquire. So he sounded very much like his lawyer underpinnings, and it was clear that counsel, which he actually retained prior to the criminal charges, it was very clear that counsel had also advised him not to make any comments. He extended that out to really rebuffing any deep commentary on the Lisa Cook situation with the Supreme Court, citing the fact that Paul Volcker himself had gone to other Supreme Court hearings in the past as it pertained to the Fed, as well as the U.S. dollar. So it was the quickest shutdown I have ever seen of a post-FOMC conference, such that the reporters started to repeat after themselves and their questions started to stumble over one another, because nothing of real interest in terms of grabbing headlines was going to be spoken about. And Powell made that very clear from the get-go.
Yeah, they weren't getting what they wanted to hear. So let's talk about catalysts for the rest of the year, good or bad. What could change the path for a rate cut?
So I think, again, I think as we get further into this earnings season, if we see a spike in layoffs, that as we saw in last October of last year, which was enormous. I mean, of course, we know that those 150 some odd thousand who were laid off last October, they've got 6 to 9 months of severance. They'll be on the unemployment rolls in the coming weeks and months. So, but if we see this trend towards rising layoffs, this next wave continue through this earnings season, then I think that even though Jay Powell may want to leave office without ever lowering rates again, I think his hand may be forced. And of course, the other thing that we'll be watching very closely going forward, especially in light of Christopher Waller's dissent today, is the jockeying for the position in terms of who's going to be named to replace Jay Powell as chair once Powell's four-year term ends in May. And by the way, that was something else he would not discuss, whether or not he was going to be staying on as a governor at the Fed.
Yeah, it didn't have to do with policy on the day he wasn't going to answer the question. All right, Danielle DiMartino-Booth, thank you very much for joining us. Appreciate it. Thank you. Up next, a look at the markets as investors await for earning results from a few of the big tech giants. We're back in a moment. North American markets pretty steady today after the central bank announcements in Canada and the U.S. Let's go to Leslie Marks on this, Chief Investment Officer at Mackenzie Investments. Thanks for joining us today.
Nice to be here, Marella.
So not a lot of reaction to the announcement from the Bank of Canada. Let's start there. That's because it was widely expected. Is that what you're thinking?
That's right. I think that everybody has a very good sense that the Bank of Canada is in a bit of a wait and see mode right now. We had lots of easing, and that was the story in 2025. And now the Bank of Canada wants to see that play through in the Canadian economy, while recognizing in Governor Macklem's comments today that we are in a period of great uncertainty in 2026. So they're keeping their powder dry for the potential if they need to cut rates if the outlook for growth deteriorates further.
Okay, so they want to keep their powder dry, as you say, in case they need to pivot later. Is that biggest uncertainty the overhang of CUSMA or Washington in general?
Well, I think you can't talk about those things independently. They're actually very intertwined. But I think for Canadians, the primary impact on our economy will be a change in the calculus or the outcome from the current agreement that we have under CUSMA. So that would be the major factor that investors would be handicapping. And that's what Governor Macklem implied. I guess the other thing I would observe is that in the monetary policy report, we did see generally generally a pretty significant downtick in expectations for economic growth in Canada this year compared with last year. And that's before we factor in any changes that could come as a result of the renegotiation.
Did that concern you? It's a growth estimate of 1.1% and unemployment is still high.
Well, I think, again, to your initial question, I think that isn't really a surprise to Canadians. We're really feeling it. We get fairly timely data when it comes to the jobs numbers. And I think that's why the market didn't really get sort of caught off guard or surprised by that downtick in expectations. I think we have a good sense that the Canadian economy is slowing, that a change in immigration policy is certainly going to impact the Canadian economy, and that most of the decisions that are being talked about by our federal government today will take a few years to play out and see impact on growth. So we're investing now for growth down the road, but the immediate impact won't be seen probably in 2026.
Okay. We've seen a broadening out of the market from late last year, continuing today. Do you think that pattern will continue?
Well, we're so happy to see that broadening out in the market. That was a key tenet of our outlook for markets. The market had become very narrow and very focused on these AI-driven plays. We have been very happy to see that the things that are driving market returns now, not just in Canada, but globally, are things like the materials sector. Obviously, the strength in gold and silver and copper prices is driving that sector. We've also seen just a general move in towards more value-oriented sectors, more cyclically driven sectors, and that's been really good. So it's no longer just a few narrow technology names driving the market, and that's a much healthier place to be. I guess the last point I would make is we're also seeing small caps performing and participating in the market. So again, a healthier equity market for investors.
Okay, you mentioned big tech, of course, which was the big driver of the last number of years. We're having earnings results from at least 3 of them today and over the next month. How much do you think that'll shift things? Or do you think that part of their story where they were the market drivers has now moved on?
Well, I think that, last year, the focus when we saw these companies report was very much top line oriented. It was that beating on revenue and even bottom line EPS. There was very little sort of focus on the lines in between. So it was really about earnings momentum and beating. I think where things have changed and why we've seen these companies pretty much stall out when it comes to that price momentum is because the focus now is very much on CapEx, capital expenditure, and the fact that these very high cash flow or free cash flow businesses are now having to spend more and invest more. And I think that this week, when we see the earnings of these large companies like Microsoft or Meta, the focus is going to be much more on expenditures for capital and what the expected return is on that capital investment.
Got it. Leslie Marks, thanks for joining us. Appreciate it. The closing numbers coming up next here on The Close. Back in a moment. You're watching the closing bells for the end of the trading day. At the NASDAQ, America needs you, ringing the closing bell. In New York, Silicon Alley ringing the bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX hits a new record close today at 33,176. It's up 79 points, or about 0.25%. The S&P 500 has just missed a record. It's at 6,978.06. Yesterday's record was 978.6. So it's down today minimally, but it has missed a new record. The NASDAQ up 40 points today, ending the day at 23,857. Let's look at the movers in Toronto. Energy fuels gaining today over 14%, almost 14.5%. That's a move of $4.75 up. Let's go to Denison Mines. It is a gainer as well today. It gained close to 9%, or 48 cents, taking the share price to $5.83. NextGen Energy also on the move today. It's a gainer. 8.5% move up, $1.48 per share to $18.84. And then Aya Gold and Silver also gaining today. It's up 6.6%, taking the share price to $27.98, just shy of $28. In the red, Aritzia, clothing retailer for women, moving down 6.2%, a loss of $7.15 per share. Novo Gold also down. It is dropping almost 4% today, 0.63, so 63 cents, down to 15.33. Lithium Americas also moving today. It is down 4.7%, taking the share price today to $8.13. All right, let's check out the movers south of the border. Bloomberg's senior equities reporter Bailey Lipschultz joins us now with that. Bailey, Texas Instruments reported earnings today, and that sent the shares up. What was the gain in the end?
Yeah, the read from management, the read from earnings is that the worries around backlogs of chips where people were kind of piling through the number of chips they had stockpiled is over. And we really saw that with beating expectations on both the top and bottom line, laying out expectations for the first quarter, the midpoint well above what Wall Street had been penciling in. So it does seem like those concerns and those jitters are now coming to pass in the analog chip space. Obviously, that's what Texas Instrument is known for, analog chips fit in things like cars and other devices. So pretty interesting beat there. As you can see, a big rally today, getting back towards those levels that we saw back in last summer. The big thing that does still continue to stand out, though, if you compare Texas Instrument to, well, most other chip companies not named Intel, the chart is still relatively uninspiring, but it has kind of been a pretty remarkable few months for the company and having its best day in a number of months after beating expectations and really talking about the fact that they are seeing demand and it does seem to be insatiable.
Okay, let's get to AT&T, also reporting earnings today. They beat on what strength?
They beat on the strength of kind of dual products. So when you look at what management was talking about on the earnings call, not only are they seeing strength in things like broadband, but they're also seeing consumers pay for a cell phone. So bundling that together, actually providing a bit of a boost for the company. As you can see, a pretty solid day today, but if you step back and look at where the stock has been trading, still nowhere near the levels over the fall, still a lot of uncertainty around how much they're spending to compete with Verizon and spending to compete with T-Mobile. So that obviously is top of mind. But when you look at least with this print and what we saw from management commentary, what we saw from the sell side analysts, it does seem at least most investors can breathe a sigh of relief as it relates to the near term. Obviously, those questions around what consumers do in the long run will be certainly something we're watching. But all things considered, it seemed like a strong earnings report from AT&T, again, leaning into their broadband devices, leaning into some of their Wi-Fi premium devices that they've launched and trying to unveil ways to better compete with the other two.
Okay, let's get to Carvana quickly. That stock is down, but that's on a short seller. What happened?
Yeah, Gotham Research putting out a report that was bearish on the company and talking about its relationship with a company known as Drive Time. So majority owned by the company founder and family of the company founder of Carvana. The big bear case was that they've been kind of propping up their revenue, propping up their sales. Company was not able to speak about that because they are in an earnings blackout period, so just want to give that a grain of salt, but it did seem to resonate with investors. But as you can see, if you look at it on a 12-month basis, even this sharp pullback today at 14%, at one point it was north of 20%, the stock's still up tremendously, so it'll be interesting to see what management reports if they address some of these concerns. We've seen a number of bearish kind of sentiment pick up around Carvana from time to time, just given their kind of presence in the used car retail space and kind of their operations. So certainly something to keep an eye on. But when you look at this company's ability to remake itself after really being one of the many companies that saw stock prices fall off precipitously after COVID, it still is up quite a bit for anyone who bought when it was, around $2 or $3.
Okay, we will leave it there. Appreciate the update. Bloomberg's Bailey Lipschultz there. Up next, earnings for Microsoft, Tesla, Meta coming out. We'll take a look at which one took a decline and what's popular with investors after hours. We're back in a moment. Microsoft, Meta, and Tesla are all reporting results after the end of the trading day. We're going to dig into them in a moment, but here first are the results from Microsoft. Second quarter results, revenue coming in at $81.27 billion. That is a beat of the estimate at $80.31 billion, which is the Bloomberg consensus. What you have right now is the after hours trading. You can see that the stock is moving down. Intelligent cloud revenue for the company at $32.91 billion. The estimate had been $32.39 billion. So they did beat there. And Azure and other cloud services revenue, XFX is what they're saying, is up 38%. The estimate had been bang on at 38%. Earnings per share coming in at $5.16. All right, let's go to Hatem Diab now. He joins us to go through some of these numbers. Hatem, you've called Microsoft the adult in the room. Why is that?
Hey, Marella, good to be on. Simply because we have a lot more clarity as to what happens with their numbers, and they're a lot more diligent about their spend. You know, they are telling you, hey, this is the money that we need to spend on AI, and this is the ROI that we're getting on our spend. And I think the numbers that you just kind of outlined there show that how good they were. You know, 38% growth on the cloud business is really good, and it shows that what they've been spending is actually bringing some nice numbers.
So they were bang on with the growth of Azure, 38%, I believe we said it was. And can you sort of expand on that number and what that means for this company?
Well, think about it. This is a company that does $80 billion in revenue a quarter. And this business, Azure, which is kind of their main cloud business, is growing at 40%, right? It's really tough to be the company this big and to grow this much. And also what's happening is Azure tells you about how the cloud business is, how the AI business is doing, because what's happening is a lot of these smaller companies have to buy some compute from Microsoft to be able to run all these new AI processes. So for us to see that the cloud business is growing at 38% shows us that all the AI processes they're putting in place are actually becoming a flywheel for their other businesses. So that's why it's so important for investors to see that the Azure business is growing.
Yeah, and that's what investors have been looking for, right? As we talked about the return on investment here. Investors have the concerns generally, and it's specifically for this company, about software and that being replaced by AI. And there was a discussion about the products that Microsoft offers and whether they're in jeopardy. What do you think?
You know, I think Microsoft gets that. What Microsoft has is very unique. They have the trust of the enterprise economy, or at least the business community, because everyone is on Microsoft software. Think about all businesses. What do they use? Who do they trust, right? I think we've seen Anthropic, for example, come up with some of their co-working tools, which is basically some kind of competitor to Microsoft's Excel and PowerPoint and things like that. So we're going to start to see a lot of these things happen. But ultimately, what Microsoft is doing is they're investing in their tools. This is why Copilot is so important, which is their AI kind of Copilot, because they know that the disruption is happening, and they're already putting a lot of work to make sure that their tools are the ones they're going to be using, since we trust them already.
Is it clear how Copilot is doing right now?
It's not very clear. I think there is a nuance that Copilot is definitely behind a little bit, but I think Microsoft gets a bit of a leeway because it's so hard to change your internal systems because a new software is there. So I think Microsoft is being very diligent about investing in Copilot, so it becomes just as good as ChatGPT or other tools out there.
Okay, I do want to just get the number to you for capital expenditure that has just come across. It's at $29.88 billion, and the estimate had been for $23.78 billion. Does that ring a bell for you?
Yeah, I mean, it's obviously a little higher than expected, but I think the reality is we all know why Microsoft is spending. They have to build compute. I think we saw them build 2 gigawatts of compute last year. 2 gigawatts is basically roughly it's 50 billion a gigawatt, so about $100 billion in spend there. If you spend, this is the back of the napkin kind of numbers, spend 2 gigawatts, you actually bring in about 12 billion in revenue from that cloud compute. So I think the spend that they're doing here, even though it's higher than expected, will bring more revenue down the road.
Okay, as you notice on the screen, the stock share price going down. Investors clearly don't like something about this. You mentioned the 38% growth for Azure, which is positive for them. We just talked about CapEx spending, which is a little bit higher. Why do you think investors are not liking so far what they see?
I mean, it's really tough to know without looking at the numbers right now. But I think probably it's right in line. It's not higher than expected. People were probably expecting more growth than the 38%. But I think the reality is this company is delivering in all cylinders, and I would not get rid of Microsoft at this point.
Okay, let's move on to Meta, which is reporting now as well, fourth quarter results for this company. Revenue coming in at 59.89 billion, so it's 24% increase year over year. The estimate had been 58.42 billion. That was the Bloomberg consensus, so a beat for Meta in revenue. Advertising revenue, which is key for this company with its social media sites, at $58.14 billion. That's up the same, 24% year over year. The estimate had been 56.79, so a beat for Meta there. The family of apps revenue, 58.94 billion. That is up 25% year over year and above the estimate at 57.47. Reality Labs, I'm going to skip over for now, but earnings per share coming in at $8.88 versus $8.02 last year. They've also got a forecast for the next quarter. For the first quarter of 2026, total revenue to be in the range of $53.5 to $56.5 billion. Meta sees this year's CapEx spend at $115 billion to $135 billion. The estimate had been under that at $110 billion. So let's go back to Adam and start with that CapEx number, which is bigger. Is it a big enough increase to be concerning to you?
Well, it's not big enough. I mean, they're very smart not to increase it too much, because that was one of the biggest concern for Zuckerberg coming out and say we're going to build many gigawatts of compute. As I said, at 50 billion a gigawatt, that's a lot of money to be spent. Coming in at 115 billion is a little bit less than people expected. So I think that's going to alleviate some of the fears that investors had. You know, we've seen the Reality Labs kind of episode where they spent all this money and then just ended up doing nothing with it. So I think that's very comforting for investors. It's probably why the stock is up.
Okay, let's talk about capitalizing on AI, which all the investors want to know about now. Would that come through basically the use of their ads and sort of curating their ads on their social media apps? And does that amount then to ad revenue?
Absolutely. I mean, you're seeing 25% roughly growth on revenue on their digital ads. I think the engagement really is really the key. I think what Meta has done is they made their software or their platform so addictive, and the engagement so good, and as a result, you know, they're very effective at delivering ads to us. I think the number that actually caught my eye is, you know, everyone's talking about the consumer kind of slowing down a little bit, but they're growing at 25% in their digital advertising. So that's actually very, very comforting and very good for their business.
You have mentioned that they aren't always clear about how they are spending, and sometimes investors want to know more of the details. Has that just been a repeated problem for them in the past?
Yeah, absolutely. I mean, they pivoted so many times from Reality Labs to the glasses to now Llama, which is their AI kind of initiatives, which really hasn't been doing that well. And then obviously you have Zuckerberg coming out and saying they're going to spend hundreds of billions of dollars. So I think investors need a little bit more clarity as to where funds are going to go on to go. But at the end of the day, if you're growing your core business, which is your advertising digital advertising at 25% and keeping that kind of pace of growth continue, that's going to be good for investors. And by the way, I'm not a big fan of this company because there's a lot of legal issues that are happening right now, but I think they're delivering on all cylinders.
Yeah, they're definitely being challenged on their social media apps, definitely for children and access there. As you may have heard, Ottawa's looking at whether or not to allow some news sources back onto the social media sites. Previously, there was a separation because news organizations were not getting paid. Does this matter to Facebook? I mean, they're such a massive company, and I'm not sure how big the Canadian market is for them.
Well, I think it matters because there is a lot. They don't pay for content, right? Or at least they don't pay a lot of these, you know, news sources for their content. There's a lot of digital content makers that make money, but it's very, very small compared to how much content is being put in these platforms. So it does matter from a principle standpoint that a lot of these news companies start getting paid. And obviously this is going to matter for the AI world too, right? There's a lot of AI platforms basically being trained on content for free. So I think setting a precedent and setting the fact that, hey, listen, if you are a journalist or a newsmaker and putting content out there, it's important that, you get paid for it.
Yeah. All right, Adam, let's leave it there right now. We're going to come back with the Tesla results and talk about that in just a moment. All right, as promised, Tesla reporting now. So let's get to the results for their fourth quarter. Adjusted earnings per share coming in at 50 cents versus 73 cents year over year. The estimate had been under that at 45-cent Bloomberg consensus. The automaker is apparently making some progress overcoming rising costs. And of course, they lost the incentive from Washington that helped Americans buy EVs with a subsidy. Eventually that ran out. And so now that Tesla is paying the cost for that. Revenue coming in at $24.9 billion, and that's down 3% year over year. The estimate had been $25.11 billion. So a miss in revenue, and I think it's the first annual revenue drop this company has had. Operating income coming in at $1.41 billion. That's down 11%. The estimate had been $1.32, and free cash flow down 30% year over year, so $1.42 billion. The estimate had been $1.59 billion. Capital expenditure, which is a big number these days, $2.39 billion versus $2.78 billion year over year. And the estimate had been at $2.83, so less on capital expenditure there. Let's go to Hatem. He's been standing by to help us unwrap some of these numbers. Hatem, this is the first loss for the company in revenue for an annual period, I think, since the first time it reported. What does that tell you?
I mean, we knew going into the sprint that the numbers are going to be bad because the delivery numbers were just negative. They lost the incentives, as you said, here in the U.S. for the EVs, and obviously the brand had a massive damage from Elon's foray into politics. So yeah, we knew that the numbers were going to be negative. I think you're seeing the stock kind of hold up after hours here is because they've lost a little bit less money than expected. I think their expenditures, or at least their operating expenses, were a little bit lower. So their spend was a little bit lower to kind of defend on that. But ultimately, the numbers are bad. Like everything is down.
Let's talk about free cash flow being down like 30% year over year, down to $1.42 billion. It was closer to $1.6 billion was the estimate, and they were lower than that. So what are they spending money on? Why are they losing this money? What's happening there?
Well, I think they're trying to. Tesla is about it's a narrative right now. They're trying to become a robotics company, and I do believe long term Optimus may be a huge business, but it's going to take a long time for that to happen. And I think what they're trying to right now to do is really to invest in retooling some of their systems, to invest in AI. I think at some point they're going to have to do a deal with XAI or something like that. So there is a lot of expenditure that come in their way, and free cash flow being negative because the core business is really losing and margins on automotive are going down is going to be a little bit problematic down the road. And I think it's up to Elon. And this stock has been trading mostly on the narrative that Elon puts out there. So I think it's really important that we listen to what he says and see if he, what story he tells us.
Okay, you hit on the button. The company has entered into an agreement with XAI of $2 billion. How important will that be for this company moving forward?
I was suspecting that's going to happen. I don't know how important it is. I think, with FSD, right? I think having, Tesla wants to be an AI company. They want it to be a robotics company. XAI has spent a ton of money buying a bunch of GPUs. They need compute. So I think that relationship is mostly about having access to compute. I don't know if they need to have access to X per se. It's just mostly about having access to those GPUs and Colossus, which is I think a million cluster GPU that they built.
You mentioned the company trying to do a larger pivot with its robotics. How much strength could we see from that part of the business this year? I mean, is that something investors can look forward to by end of year, or is it much further down the road?
I don't think anybody is running to buy an Optimus robot tomorrow or this year. There's a lot of issues still there. The product is just not ready. It's just not ready for the market. It's not ready for consumers. It's not a consumer product just yet. I think there is an understanding that maybe down the road, it's going to be a big market. But it's definitely not something that we can expect anything from in 2026 and maybe not even 2027.
Okay, what about robo-taxis? Of course, a lot of money there. We know that they have done some trials in the U.S. and regulatory seems to be moving in their favor. What do you see for robo-taxis?
Well, the FSD, the full self-driving story, is really a good one for Tesla because they are trying to build the software to be vision only. And they're not there, right? Like I think Waymo is there. They have basically level 5 autonomy. Tesla started the robotaxi business, but it's still supervised, or at least there's only a few that are working in very few locations. So they're definitely behind. But should they accomplish and execute on that, that would be a good business. You know, I just drove for 2 hours on Sunday with the FSD, and it's really fantastic. The problem, it's not 100%. You know, and I think the problem with having software like this, where if it doesn't work 100% of the time, someone dies, is very problematic. So I think Tesla is just not there, and hopefully they get there this year.
All right. So should we continue to expect losses from this company moving forward, considering, as you say, they're in the middle of the pivot and the EV market, there's a lot of that's slowing down quite a bit?
Yeah. So the core business is selling electric vehicles, right? And we lost the incentives here in the U.S. I was in Europe last week. They've seen very few Tesla. The brand damage in Europe is massive, right? So I don't think the core business will do any better going forward, simply because of all these kind of macroeconomic things that are happening to the company, and some of the micro things because of Elon's forays into politics and some of the brand damage that happened. So as a result, you know, I don't think in the short term you will see the core business grow at all, and that's unfortunate. And the stock is trading at pretty insane valuations to justify this this lack of growth, basically.
Okay, Adam, I got to leave it there. I'm out of time, but appreciate you sticking around for all the earnings that are pouring in today. Adam is managing partner at Gerber Kawasaki Wealth and Investment Management. Coming up, we'll have more market reaction and take another look at the S&P 500. Which is today just shy of the 7,000 mark. We're back in a moment. Stay tuned. Here are the stories making headlines today. Amazon cutting about 16,000 jobs as the tech giant continues to streamline operations with rising AI competition. The American firm says it is not their plan to announce broad staff cuts every few months. The elimination took Amazon's announced job cuts to 30,000 in 3 months after that initial wave in October of last year. Employees were warned that AI will shrink the workforce as Amazon automates more of its operation. Eli Lilly struck a deal today with German biotech company Seamless Therapeutics, worth $1.1 billion to develop gene therapies for hearing loss. The American company will get exclusive license to use the technology to develop experimental drugs. Gene therapy has become a key interest area for the drug maker. About a third of Lilly's pipeline is now genetic medicines, most of which are still in the early stages of development. Toronto-based startup Wabi has secured $1 billion in funding for commercial expansion. The Uber-backed company develops self-driving technology for trucks. Huawei received another $250 million in funding from Uber to launch at least 25,000 robo-taxis equipped with its software exclusively on the ride-hailing platform. And the Bank of Canada held the key lending rate steady at 2.25%. The bank offered new forecasts in its monetary policy report and sees Canada's economy growing 1.1% this year. Policymakers citing heightened uncertainty on questions about how long the rates could remain steady. All right, let's go to Paul Christopher. He's head of global investment strategy at Wells Fargo Investment Institute to talk a bit more about the markets today. Thanks for joining us.
Sure.
No big leaps and bounds on the major North American markets today with the decision to hold the rates both here in Canada and the U.S. Do you think it was the right decision for the Fed?
Well, the Fed is really in a bind because they've got steady inflation and some improvement in the labor market, so they really don't have a lot of cover to cut rates here. That's their reasoning. We do see improvement in the labor market. We do see improvement in the U.S. economy going forward, so we think the room for cutting rates is probably less than it was last year.
Okay. The S&P, though, is still strong, a little off that 7,000 close mark. Where is the strength of the U.S. economy coming from?
So it's going to be coming from spending, especially on services. And then the second sort of leg of spending, if you like, is all that technology spending. And people talk about artificial intelligence, but there's a lot of automation that's going on, and not just to cut jobs, but there's automation going on that improves the quality of products in places like biotech and pharmaceuticals. So there's quite a lot of that spending going on, and that's what one company spends is another company's revenue. So those two, I think, are the strong drivers for the economy this year.
So, Paul, do you have any concerns about a partial government shutdown?
No, not really. I mean, it's sad to see it happening once again. We can't seem to get the 2026 budget completely in the books. But look, for investors, let's take some solace here. They still have they have some of the budget bills passed, so it's not a complete shutdown. And they probably, in a midterm election year, don't want to stay shut down for very, very long. So we think the markets will generally look past this one.
Okay, you mentioned the tailwinds that you see this year. Do you still think the labor market will hobble along this year, or do you see some gains there as well?
Gains there as well, but not sort of giant, 150,000 sorts of jobs per month. Not those days are behind us a little bit. But we do see some stability in the labor market here going forward. Especially small businesses have been indicating for the last 5 or 6 months that they intend to hire more coming into 2026. Lower interest rates, the lower interest rates we already have, should help quite a bit in that direction.
You mentioned the big tailwind of AI and the CapEx spend for some of those bigger companies, the hyperscalers. Are you pivoting that tech investment at this point? Where are you putting it? Because it's anticipated it'll be a tailwind this year, but maybe not as big as it was last year.
Well, yeah, maybe not as big as it was last year, but remember last year it was a multiple story. It was a story about people paying up for something that they thought was going to be a long-term trend. We do believe it will be a long-term trend, but now we need to see the earnings come through. And fortunately, the earnings growth that we see is more broadly based in the S&P 500 this year. So it's going to be, we think, an earnings-driven year with broad-based participation across the sectors. And you can see that in the recent market performance where the cyclicals have really dominated sectors like energy and materials, industrials. So we expect more of that to come. We think tech will find its own way.
Okay, but are you managing the tech stocks any differently this year from last?
No, not really. Look, we think the trend has legs. When I say the trend, I mean the trend in spending on capital equipment. We don't know yet what the adoption rates of AI are going to be or of automation, but we can see very clearly in company guidance that the spending rates are intact, and we're going to try to play that trend, but we won't overpay. So last year, we got into tech and communication services early in the year after DeepSeek. Remember that? Mm-hmm. Pushed tech stocks way down. We bought into that, went overweight those sectors, over their market weights. And then when they got to be 30, 35 times 12-month expected future earnings, we said, that's a little bit expensive. Let's take some profits and roll that money into trends that we think are ancillary or subsidiary to the main tech trend. So you might think of data centers, for instance. And all of this automation that's going to be coming our way is going to require a lot of power. That's going to mean rebuilding and redoing renovating a lot of the power generation and power transmission across the country. And so industrials and utilities were pretty good picks for us last year. The utilities have suffered a little bit lately. We still think that's a good pick. It's a good time to buy. And then the third pick would be financials. Financials with the steepening yield curve, with more companies seeking to borrow, especially to fund tech purchases. We think financials will do well this year. They also have struggled lately, mainly on policy anticipation, that, for example, the interest rate cap on credit cards. But we think that's going to be a good play for the longer run, and we would still favor the financials, industrials, and utilities.
How are you looking at fixed income these days?
You know, the long end of the yield curve looks pretty volatile right now, and it's that way around the world. If you think about German bunds or the French or the Japanese government bond yields, the Japanese government bond yields moving a quarter of a point in such a short period of time hasn't happened in years and years. And we're seeing the 30-year U.S. Treasury also move higher. So we think you're going to see some ups and downs in that 30-year in the long end of the yield curve as we move forward. And of course, that's where investors have the most vulnerability to yield changes because of the long duration, the long maturity of these bonds. So we're favoring the middle part, the intermediate part of the yield curve. A 3, a 5, a 7 doesn't get you a yield that's a whole lot lower than a 10-year, but you have a lot less exposure to that rate volatility.
All right, I do have to leave it there. Paul, thanks for joining us. Paul Christopher, Head of Global Investment Strategy, Wells Fargo Investment Institute. Coming up, the popular coffee chain Starbucks reported some mixed results, but some think the turnaround has finally taken hold. We're back in a moment. Starbucks shares up today despite missing their first quarter earnings estimates. The coffee chain says its traffic grew for the first time in 2 years. And to break it down, we were joined by Peter Saleh, Managing Director Analyst at BTIG.
If you look at the traffic, it was up substantially this quarter. So clearly they beat on same-store sales, 4% globally, 4% in the U.S. That's about 200 basis points better than what we were expecting. But sequentially, traffic was 400 basis points better. And on a 2-year stack basis, it was 600 basis points better. That's the hardest part of the turnaround, which is getting customers to come back into your stores. And so that problem looks like it was solved or somewhat solved, at least the first step of it solved. So we're getting customers back into the store. So that's what the investors are liking here. And that's what's driving the shares higher today.
All right. And now CEO Brian Niccolo, when he came in, the back to Starbucks strategy, is this the results of it? And what has he done that's making this work or appear to work?
Yeah, I think the foundation was really investing more in labor hours and more labor in the stores, taking complexity out of the menu, reducing the menu by 25 to 30%. And so the end result here is faster service times. They're under 4 minutes in both in-store and in the drive-through as well. And so customers are seeing that and they're coming back more often. I think the next phase of the growth here is going to be menu innovation, both in the morning and in the afternoon. And they're pressing the accelerator a little bit more on the marketing side as well. So I think those are the foundations for this turnaround so far.
And how important is that speed for customers and keeping them coming back?
Yeah, I think it's very important, especially in the drive-thru and especially in the morning. Customers they don't want to wait. If there's a long line in the drive-thru and your service times are too slow, your drive-thru can back up. Customers can drive right by the store and not come in. So I think it's very important. We've seen it time and time again in the restaurant space where you increase throughput, you increase your service times, you move faster, and you're able to drive some accelerating traffic trends.
And they want to add, you said they wanted to add to the menu, but they've reduced the menu. Is there a danger of those two canceling each other out?
Yeah, I mean, I think they've reduced items that weren't selling from the menu, and they're going to focus on, healthier trends, energy drinks, different food for the afternoon. So it gives them a chance to be more innovative by reducing some of the items that previously weren't selling. I do think that's going to be the next phase of the growth for them.
And then going the other way, I was reading the $2 billion in cost cutting over, I think, the next 2 years. Where will they find that? And I mean, if they're bringing in more staff, how they, that's the biggest expense. How do they work with those two things?
Yeah, well, we're going to hear a lot more about that tomorrow at their investor day, but they've outlined $2 billion of cost cuts that they're going to get over the next 2 to 3 years. My guess is that'll come from supply chain and some, efficiencies using technology within the stores. But I think a lot more yet to come on those cost reductions. Tomorrow when we hear more from them at the investor day. So expect a lot more detail tomorrow night into Friday.
Okay, and then let's talk a little bit about China. They got out of it as owning all of it. They're working with Boyu now. How is that starting to come together for them?
Yeah, I mean, look, they sold a significant portion, a majority stake of that business. They're going to use that capital to pay down debt. They're still going to retain a minority interest, or about 40%, with a pretty high royalty rate. I guess the upside to us was they only talked about it being a couple pennies dilutive to their business. We would have thought it might have been a little bit more than that. So I think that's really good news for them. But again, the deal hasn't closed. It'll close here in I think the second or third quarter of this year. So a little bit longer to go. But again, hopefully we'll get a little bit more details on that transaction sometime tomorrow as well.
Yeah, and do you feel that's the way to go for them, or we have to wait for the details?
Well, look, this was announced months ago that they were gonna do this, and it was rumored for months before that they were going to sell the China business. So it's a done deal. At this point, we're just trying to figure out what the economics and how the economics work going forward, which is still a little hazy in our view.
All right. And any potential headwinds for them going into 2026?
Look, I think the consumer is still stressed, still under pressure. Inflation's still hovering around. So if you look across the restaurant space, there isn't a lot of great news recently, especially in 2025. I think you're battling for market share here. So that is definitely a headwind. But look, they've got some levers in place to try and combat those headwinds, and so far they seem to be winning. And their commentary on January suggests their trend continued to be very strong in that month as well.
Peter Saleh, the managing director and analyst at BTIG. Coming up next, U.S. dollar fell yesterday to the lowest level in 4 years after the American president, Donald Trump, insisted the currency is doing great. More in a moment. Yesterday, the U.S. dollar experienced its largest single-day decline since April after Donald Trump said he believes the greenback is doing great. Let's get some insight from Terry Wiseman, global FX and rate strategist at Macquarie Group. Thanks for joining us today.
My pleasure.
Why does Donald Trump seem unconcerned about the decline in the dollar's value?
Well, probably because he doesn't mind that the dollar is getting weaker. I think that Donald Trump, as far as policy objectives are concerned, has always talked about the prospect of trying to reduce the U.S. trade deficit. Now, that might be the case because he thinks that a reduced trade deficit would be associated with greater manufacturing jobs in the U.S. He can claim at this point that whatever it is that he has done during his administration has helped the trade deficit come down. In fact, since the middle of last year, the U.S. trade deficit had come down quite a bit. And I think he wants to be able to at least show that he's had a success in that regard. Leading into the midterm elections. And of course, if you get a weaker dollar on top of whatever effect you're getting from the U.S. import tariffs, and that does help reduce the trade deficit even further, obviously he can claim an even greater victory. So it's certainly something he doesn't mind seeing, that is the weaker dollar.
Okay, how does it affect affordability? Because that's a big concern for the average American.
Of course, if this were to start becoming a problem for prices of goods, especially imported goods into the U.S., it would affect affordability adversely. I think here, though, that perhaps the president is counting on the prospect that if he puts in place or nominates a chairman to the Federal Reserve that is going to be dovish and abides by the White House's wishes to reduce interest rates or keep them low, he can at least make the case that with regard to mortgage rates and interest rates, he has preserved affordability, because a large part, of course, of households' outbound expenses or cash outlays are interest payments on mortgages, on consumer debt, et cetera. So it's a balancing act for sure. But I think at its heart, it's still about trying to show that the U.S. is producing things, exporting things, and that the rest of the world has less access to the U.S. market.
Okay, so it would be an offset in his mind, even if prices start to go up on imported goods. He's going to give the Americans a break on their mortgages, which could be sort of a bigger break for them.
Conceivably, keep in mind also that it's possible that the increased revenue that the federal government is receiving from the imports could always be refunded in the manner of lump sum cash payments back to households, effectively improving their sense of affordability as well. So there are a few avenues and tricks, let's say, by which the goal of achieving affordability can be achieved.
Has that been floated by Washington, the idea of a lump sum payment to a certain component of the American population?
Yes, it certainly has. I mean, there was already a program from a few weeks ago to transmit those benefits to veterans and to active military service people. It doesn't have to be a broad program, but it's still out there. And I think if you ever were to get in trouble with the issue of affordability, it's simply an out that he can resort to.
Okay. What is your take on whether there is more downside to the dollar moving forward? And if so, what would trigger that?
Well, I think what would trigger it is the thing or the narrative that's already been driving the dollar weaker. There is a growing sense out there among foreign investors and investors that have exposure to the dollar that the dollar is expensive, or certainly got expensive in the long run up in the real value of the dollar between 2013 and 2025, or at least early 2025, that because the U.S. is acting erratically on the global stage, that because there's a lot more policy uncertainty domestically, that it may not be so wise to continue to invest as heartily as foreign investors have done in the U.S. over those last 13 years, and that some rotation, if you will, out of the U.S., some diversification out of the U.S. is warranted. So that theme will stay with us as long as the U.S. is perceived to be acting differently, if you will, than it has in the past.
How do you see the Japanese yen, or factor that in? Because we're seeing the strength there and we're seeing the sale of U.S. assets. How does that play out this year?
Well, it's a bit of a sideshow to the broader theme of dollar weakness. Certainly in the last few days, the dollar has weakened relative to the yen as well, but it's all part and parcel of a broader weakening of the dollar. I think the only thing in this regard that makes the yen somewhat special is that at least here we can point to the premise that the Federal Reserve, acting on behalf of the U.S. Treasury, which was in turn potentially acting on behalf of of Japan's Ministry of Finance, did try to weaken the dollar by making price checks into the market last Friday. If that's the case, though, it would only corroborate the view that the U.S. Treasury, the White House effectively, is okay with a weaker dollar, in this case against the Japanese yen.
Terry Wiseman, I got to leave it there, sir. Thank you very much for joining us. Appreciate
My pleasure.
it. A quick recap for the end of the day. We had big tech companies reporting results after the end of the trading day. Microsoft was the first one we talked about today. As you can see, it's down in the after-hours trading by almost 5% to 458.50. The company's AI hardware spending surging to a record high. And investors, of course, concerned about how that's going to pay off over the longer run. Let's get to Meta, which also reported today after the end of the trading day. Shares moving higher today. The company said it expects robust revenue this quarter that will support the AI spending, big AI spending for them. And then Tesla is higher in the after hours, gaining here. at 3.2%. After reporting higher than expected profit for the fourth quarter, and they revealed an investment plan with XAI. That does it for the close today. Thanks for joining us. We'll see you back here tomorrow.